more than that
like
amount.
You can be in a 401k and a 403b and
Well,
like how,
do you have multiple jobs?
yeah. If you're in a 401k and a 403b, if you have 2 jobs, you can't put away more than $16,500, which is the limit this year.
That's really not a problem.
Yeah, but the answer is yes, up to certain limits.
Okay, and if you like the Roth IRA, can you do that and one of those other?
Yes, you can do IRAs and be in a company-sponsored plan. The difference comes in, and I was going to get to this later, but the difference comes in whether or not it's deductible, whether or not you can take it from your taxes, lower your taxable income, and that really just depends on how much money you make.
Now, do you think that's like smart because the IRA, they don't, like Beth Tfiloh would match that, right? But they would match a 401k,
Yeah.
so maybe.
Yeah, and that's, I think my advice is always to max on the 401k first. Put as much money away as you can in that. And there's a lot of different benefits, and I put some of them on here, but the fact that it comes out every week or whenever you get paid, you don't see it, you don't have to think about writing that check to the IRA each year, which some of us, we're not good at setting the money aside, might not be there, and you can save a lot more and often get a match if your company will do that. And you can always do the IRA as well. And I recommend if you can, you should. Okay, so we talked about the fact that it comes out. The other benefit is you can take advantage of market swings. And I put regular systematic contributions. Our industry likes to call it dollar cost averaging. I don't want to get into fancy terms, but essentially every period, whether it's monthly, weekly, you're going to be putting a certain amount aside. If the market or whatever you're investing in is 100, it drops to 75, and I put an example on here, you can actually start to buy more. So a lot of people are concerned when the markets are very volatile and they move up and down, and people get scared and read the newspapers and watch TV. For young people, that's the best time to be putting your money away in the 401ks, because it's like getting a sale. You go shopping, or eggs or jeans or whatever you want to think about. You're able to buy more of it, and then when it goes up later in time, which historically markets do go up over the long term, you're going to be that much better off because you're able to buy as much as you can when it was at a discount. Yeah.
I'm not saying I'm doing this anytime soon, but if I were to ever cash out my 403b or whatever I have, how much money that's in there will I actually get?
Okay, so first, don't do that.
I'm not there. But in case I need cash.
Well, another benefit which I didn't talk about is that if you invest in 401ks or 403bs, often they have loan provisions. So you often can take a loan from your account. Again, don't do that. It's a bad idea. You're taking it out from an account that you put in pre-tax, but you have to pay it back with after-tax money. Then when you put it back into the plan later, you're going to be paying taxes on it again when you retire. So you don't want to do that. But if you take the money out early, before age 59 and a half, you're going to pay ordinary income tax, which is basically, it's added on to whatever income you had, and there's a 10% penalty. So that's when we talk about striking that balance. We need things like the 3 to 6 month emergency fund. You need to pay your debt. You need to have money set away for retirement, but you want to just have those in line. You need to balance everything.
Most Americans don't save enough. It's kind of a sad situation. Most people aren't saving anything.
One great way to dump some money into an IRA is if you get a tax return.
Yeah.
When you get a tax return, if you don't need the money, it was kind of unplanned that you're getting a return, take half of it if you can, and
put the refund
make
away.
your contribution.
Yep. All right, I don't want to bore anybody. Let's real quick talk again about everyone understand the difference between the IRA, traditional IRAs, and Roths?
How often do you have to invest in an IRA?
You don't have to at all.
So it can just be whenever you feel like it.
And yeah.
Okay.
And it's the same thing with your 401ks. I mean, you can stop and start. You probably have to just wait for your employer's payroll periods. But you can always increase your contributions. You should, over time. As you get a raise, you should add a few more percentage, points to the amount you're deducting.
what happens if you're being matched and then you stop working at your current
Well,
place?
any money that, and I had a bullet point on this, any money that you put away out of your pay, it's always yours. So
The matched part?
the match part is subject to, typically subject to a vesting period. And what that means is you have to be at the company a certain amount of time in order to get, that's it, either graded or you have to be there for a three-year period,
Okay, so I
and then you
should've
get all
started
the money.
5 years ago.
But it basically just, you have to be there a certain length of time in order to walk away with the money that they gave you.
Is
Okay.
there a vesting schedule? Did you ever hear that?
3 years.
I don't know,
3
but
years?
it's 3 years.
It's not bad with 3 years.
3 years means that you have to be here 3 years to get any of it, and after 3 years, you're gonna get all of the match that they gave you.
It's called a cliff.
Yeah. So, I talked about the traditional, I have booklets on IRAs if you guys are really interested, but basically the difference is, do I pay the tax now, Roth, do I pay the tax later, traditional. Both get tax deferred or tax-free growth, but they both are appropriate in different stages of your lifestyle. The other thing is when you leave a company, you can roll over to either another company's plan or an IRA, and you can manage it on your own.
The bulk of Americans take the money out, spend it,
Yeah.
and they
Don't-
lose half of it to tax.
Don't cash out. The one other thing I wanted to say is I find the biggest thing you can do is automating your savings and investing decisions. You automate it if you join a 401k because it's like jumping into a pool. You jump in the first few pay periods once you decided to join that plan. You notice that money's not being there. The pool's cold, but after a while you get used to it, and then you learn to live without it. You don't notice the money not being there. But you want to do the same thing with debt. You want to set up automatic bill pay. You don't want to miss a month just because you forgot or got busy and didn't have that ding your credit report. And you want to automate savings, direct deposit into a savings account, so that you're checking. You don't see that money there. You don't have to make that decision. Do I save this or do I go to the bar? You don't want to have to make that decision. It's a lot easier to just set it up and forget about it. So that's my prepared remarks.
We're not plugging you guys, but one thing that you haven't mentioned is that you have to strategically invest the money that you're putting into an IRA. You don't just dump money into the bucket and hope that the bucket, Tara left, but she said, how do you get the 8%? Well, at our age, you meet with somebody like you guys, which feel free to hand out business cards if you're not, but meets with somebody like you guys and figure out how to invest the money, split it all up, don't put it all in one basket. That's the kind of the massaging magic of getting that return on investment. You can't just dump it all there, invest it in CDs and expect to make any money.
And a lot of people, know what I do, and they say, Joel, how do I get $1 million? Well, you have to put a lot of money away first, and that's how you do it. You systematically save over years and years and years, and then you wake up and you're 65 and you get a nice nest egg there. It doesn't just happen overnight. You don't just get 50%, although the last couple of years have been pretty good. But you don't just get those returns every single year. You have to just stick it through and through.
I'm in favor of inheriting.
Yeah, and that's nice too. Just either marry rich or have rich parents.
That's
That
the
helps.
best way to do it.
Yeah.
Lottery
But-
tickets.
Lottery tickets, they're pretty poor investments.
Can you lose this money?
I'm sorry?
Because, I don't do this at all. If you put this money, you're investing this money, can you lose it?
It all gets to
That's
how, it all
A
gets
nice
to how,
segue for Josh.
it all gets to how you invest it.
Right.
What he was saying, these are just accounts, it's a wrapper, it's an account. What you do with the money, where it's invested, it's a whole nother big discussion, is how you invest the money. There's a range of investment options. If you invest
Yeah, I just looked
conservatively,
at my 403b and some of them went down
Not
this
an
month,
account.
and I was really not
Not an
happy about that.
account.
Like
That's
by $10,
That's
but
the thing.
still.
Well, I'll let
What
Josh,
happened?
you take this.
To one of these kind of guys, figure out how to invest. You have money
That is
to
very
be-
true.
Yes.
No, What are we doing?
Josh is
That is stressful.
Lindsay said her dad has a good accountant. I said, I learned the hard way. I used to use an accountant who also did investments. Bad idea.
Well, not
They were
necessarily.
too, well,
It was bad
in
idea
this
for you.
situation, it wasn't a bad idea. He made me a ton of money, but an accountant wears a little bit of a different hat than a straight investment person. When I switched over, I'm sorry, I'm with Merrill Lynch, but sorry, but performing much better than the last 2 years, even with all the volatility, than I ever was with somebody who was looking at it from a accounting point of view, I guess, rather than from an investing point of view. He had a license to invest, doesn't mean he was good at it.
Very true. Very true. Well, as you know, I understand you're a physician, or you're the physician. Yeah. So the person who graduates last in their class, what do they call it?
Doctor.
Doctor. Person, it's not very difficult to pass the number of exams, to be a professional in the financial field. So longevity, asking other people who they trust and confidence, that's going to be part and parcel of that choice.